Banks must accept risk in order to achieve their business objectives. But accepting risk means that it must be monitored and managed over time, something that has become more challenging for banks in recent times. This is because the size, nature, and complexity of the risks that banks have become exposed to has changed substantially. There are several reasons for this. First, the range of products and services offered by banks has increased significantly. Secondly, banks' business models now enable the delivery of these products and services through multiple channels. And thirdly, the external environment in which banks operate continues to evolve. A consequence of this is that banks have become more reliant on technology. In return, this has exposed them to new risks such as system outages and cybercrime. In addition, increasing concerns over sustainability and climate changes is focusing regulators' minds on impact of climate-related risks on banks and their customers. All of this provides context for the risk management challenges that banks face today. Banks' business models are based on the acceptance of risk to meet absolute and risk-adjusted return thresholds. They undertake many different activities to generate income, but these activities also give rise to various of risks. For example, providing credit facilities, this creates credit and other risks. Accepting deposits, banks must account for such transactions and be able to repay customers when funds are requested. This results in operational risk and liquidity risk. Placing funds, banks place surplus funds with other banks, which means they take credit risk on those banks. Settlement risk and operational risk are also a concern. Handling trade transactions, this gives rise to operational risk, market risk, and credit risk. Making payments. Payments in and out must be processed, accounted for, and net amount settled through clearinghouse and exchange. This involves operational risk, but can also incur credit risk and settlement risk. Trading. Buying and selling FX or traded securities can create credit risk on customers and third parties. It can also create settlement risk, operational risk, and market risk. Providing risk management products to customers, for example, derivatives and other hedging products, result in credit risk, operational risk, market risk, and settlement risk. These activities can also expose a bank to reputational risk if unexpected events occur. Customer expectations are not met, or issues are not dealt with quickly or appropriately. The risks associated with the activities just described are sometimes referred to as upside or opportunity risk. However, there are many risks such as fire damage, non-compliance, fraud, and cybercrime, etc., that generally only have a downside. Banks must minimize the possibility of such risks occurring and their impact should they occur. Taking risks generates earnings but also result in risk-related costs. For example, risk resources. Banks need people, premises, and systems to set risk appetite, make risk decisions, and monitor and manage risk exposures. Operational errors. For example, compensation must be paid if payment delays or other errors occur. What about trading losses? Selling an asset at less than the purchase price will incur a loss. These costs appear above the line and are not always easily traceable. Trading losses, for example, are offset against trading profits, with only the net value being reported. Credit losses appear below the line and are incurred when a customer fails to settle its obligations in part or in full, with the differences shown as a deduction from profit. But credit losses can fluctuate significantly, rising sharply in an economic downturn and falling again in an upturn. Another significant cost is the cost of capital, the return paid to investors that provide capital to support risk-taking activities. The riskier a bank is perceived to be, the higher the rate of return investors expect and the higher the amount of capital required. Thanks for watching, and we will be looking at key risk concepts, including risk capacity, risk appetite, and risk exposures in the next session.